CNBC-TV18. This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Morning.
Hi, good morning. It's all smiles, right? Before the holiday, the market is shut tomorrow. And it's that long weekend feeling, although not a long weekend, but nevertheless.
It's only Wednesday, but there's only, a day more to left. 2 days, I mean, if you count today, but we already started today. So.
Yeah. But we're bracing ourselves for the next good couple of weeks with regard to these truncated weeks.
Yeah.
And hopefully the...
Next week is the big one, right?
The big one,
there's a Tuesday and a Thursday.
And a Friday.
But you know what all of that is going to bring about, right? Really low volumes, hardly any participation, and comatose kind of a market, which I think we are used to for the last many days.
Yeah, I mean, actually, yesterday, Sonia and Nigel, was very lethargic. The price action was, it was comatose, as Sonia said. And I think are we starting to see the first signs of, all that manic price action from last 2 weeks starting to settle down. At least the week has kind of begun that way. So let me just quickly run you through the top things to watch out for. Starting from, of course, what we've got the handover from Wall Street. It's a quiet session in the US as well, not very much. No new headlines around the banking issues, around the financial sector. NASDAQ was down about 0.5%. The US 2-year is at about 4%. It's basically hit a little over 4% twice and then kind of retraced from there. The dollar is slightly on the back foot. The DXY index is down about 0.25% or so. So this is a very kind of okayish kind of picture. The S&P 500, by the way, is below is above the 50-day moving average. Is below the 50-day moving average, but still above the 200-day moving average. And you may be wondering, right? I mean, all what has happened with the banking crisis in the US and US markets, US big indices are still absolutely okay. And the reason for that is rotation. So tech and communications as two big areas which have outperformed the other sectors, the value sectors, hugely in 2023. As the banking crisis started to show up, these two sectors outperformed. The NASDAQ outperformed. The communication part of the US market outperformed. And as banking crisis is receding a little bit, at least we're not getting fresh headlines, you're starting to see this underperformance on the NASDAQ. Money is moving out of tech in the US, out of NASDAQ, into some of the value sectors. You're starting to see this underperformance vis-a-vis other sectors in the NASDAQ over the last few sessions or so. In any case, I mean, markets are awaiting the next clues in terms of inflation, what the Fed will do, and of course the banking situation as well. And all three are in that sense really up in the air. We don't know which way things will go. By the way, we will hear more from the FIDC, which is the depository in the US, the banking depository, and the Fed on the recent bank failures. So they, representatives from both these institutions presented before the Senate last night. There were no headlines, but they will do the same before the House, and it'll be watched keenly again for any sort of headlines which we get. Here in India, I mean, it's been painful, right? Yesterday was, at least at close with that 20-25 point cut on the Nifty, a repeat, almost an exact repeat of what we had the day before yesterday. Although yesterday was, day before yesterday, we had that big spike late in the session, which got sold off. Yesterday, we did not even have that. So 0.25% lower. Banks did better. I mean, the bank Nifty actually ended higher. On the Nifty, bulls will not give up hope as long as the 16,800, 16,850 level. We are not there yet. It's a slow grind. But if there were to be a retest, and for the third time the market bounced off those levels, I think at least on the index, I mean, the view is emerging that maybe, prices have corrected quite a bit. For the broader market, it's a different story. I'll come to that in just a bit. Now, the Nifty has resistance. The levels are the same, 17,207, the 20-day moving average. There is a little bit of change. That stands now at about 17,230. These are near-term resistance levels on the upside. The Bank Nifty closed higher, as I said. It's a small higher, low, as opposed, yesterday, Tuesday, as opposed to Monday. So don't read too much into it, but the margin, it's positive price action. For the Bank Nifty, crossing the 20-day moving average, which now, as of yesterday's close, stands at 40,065 and 40,201, will be important to watch out for. Sonia.
Oh, absolutely. And, now the line in the sand is that 16,800 mark, right? It hasn't been it has held so far. It's not given up yet. So I guess 16,800 to 17,500 is sort of a marker for the market, for the Nifty, that is, the range, the floor and the ceiling, so to speak. But it is a very, very range-bound market, no two ways about that. Even in the global markets, I mean, the US markets, they had mild losses, nothing much to write home about. S&P 500 was absolutely flat as well. If you look at the flows, though, in our own market, there is positive there. So the FIIs have bought in cash after 3 days of selling. FIs bought about 1,531 crores yesterday, and the domestic institutions barely sold anything. So net-net, it was positive in terms of cash market flows for our own index. So that's a good thing. There are a lot of things, right? There is the March series expiry that happens today. There's a market holiday tomorrow. So, and there's a year-end closure as well. So given all of that, there could be a little bit of volatility, given that there's the March series expiry and year-end closure. But other than that, this is a defined market range that we're looking at, with 16,800 on the downside. In fact, the 24th March low was 16,934, and that's something that has also been held up until now. So let's see, very, very range bound, and you know, cues are thinning out. There's no major trigger. Of course, earnings season begins in the first fortnight of April. So 13th, you have Infosys numbers. But up until then, I guess auto sales is one trigger. But other than that, not much.
Well, that's right. You know, so today is expiry day. So expect volatility to pick up, particularly in the second half of trade. And the big question is, do we put an end to this gruesome series? March series hasn't been a great one at all. The Nifty is down close to around 3%. Or do we see some bit of a relief rally that plays out? That will be on the bulls' wish list. But you know, besides the headline index, we talk about it being in the range. The broader markets have been getting pummeled, and it's long due for a good pullback. And I'll get to that in just a bit. But just telling our viewers out there that there are a lot of good quality stocks out there that have seen a big correction. Some of them valuation-wise as well have become attractive. So just keep an eye out on the broader markets. Don't lose heart, because there are a lot of good quality names in there to invest. Looking at the index first, on the index futures, the FIs, well, they added shorts yet again, so they got back to their shorting ways. Short positioning moves to around 84% or thereabouts. But what's giving you some hope that maybe the recent lows will hold out is that they wrote puts. And if you're looking at the option setup, the highest open interest on the call side is at around 17,000 call, and that's 50% higher than the open interest at around that 17,000 put itself. So that's telling you the kind of bearish sentiment you get, which brings us to the levels. Since 17,000 call has the highest open interest, the positioning is such that 17,050 does hold out. If there is some kind of good news that comes about, and if we can get past that 17,050 and trade about that, then you're bracing for a short covering bounce. Otherwise, at 17,050 will be a marker to watch on the upside. And the hope is the recent lows don't break. On the Nifty Bank, you know, last few days we have been seeing selling in the broader markets as well. But the Nifty Bank at around that 39,250 to around 39,300 odd, it's getting some bit of a support. So that becomes a support zone. While on the upside, the 200 EMA, which has not been able to cross decisively, that becomes a resistance out there. But I told you all that the broader markets could be bracing for a big relief rally, at least in the near term. And maybe in the near term, we could be forming some sort of a base in the broader markets. I'm talking about the small cap index, because a lot of participants, they could have sold some positions for tax harvesting. That's a possibility. Tax planning, this final day. So maybe we get some bit of pain more, and then maybe in fact we see a bit of a bounce. And also in select pockets, valuations have become very, very attractive. And just to drive home this point, the small cap index wasn't underperforming till now. Just in the last 5-6 days odd, you have the small cap index that is down a good 4.5%, while the Nifty is down marginally. I think if we can get that chart up for you on the screen, yeah, that's the one I'm talking about. The Nifty is down less than 1%, but the big pain has been the small cap indices. That's telling you there is some tax harvesting that was taking place. And that's why, you know, wherever there could be an exit, it appears there was some exit that was taken. So let's hope that we're bracing for a bit of a bounce, particularly in the broader markets. SGX Nifty is suggesting a bit of a flat start. I already gave you the range out there.
Oh, absolutely. And you know, although the headline index may look like not much is happening, right? Beneath the surface, there was so much pressure yesterday as well.
Absolutely.
I mean, not just the Adani Group stocks, but a whole host of other names in the mid and small cap stock list were down about 5-6%. The new age tech companies were under pressure. So we get fooled by the headline index being range bound, but portfolios are getting hit quite hard.
And the broader market soon has been in pain. You know, earlier post-COVID, everyone used to say I made 2x, 3x returns on a particular stock. Now it is the stock down 40%, or is it half, or is it more than that? You know, that's the kind of pain we've seen in the broader markets. But the point is, there are a lot of good quality stocks out there. Look at good margin business, good market share, and look at good quality businesses. There were plenty out there. You know, I did a rough check out there. So let's hope there is some
Nigel, I have some numbers. So NSE 500, right? I mean, this is the broadest gauge of stocks out there. So since the 3rd of Jan, 4th of Jan is when the NSE 500 made a high and then it started falling. So from the previous day close, 3rd of Jan, you have 116 stocks on the NSE 500 which are down more than 20%. That is almost 25% of the NSE 500 group is down more than 20%. And then when I say more than 20%, it's 30, 40, so but 25, a quarter of the universe is down over 20%, and only 87 stocks are in the green, so just
that's less than 20%.
Yeah, I mean, so it's been tough, and that is just this year so far, just 3 months or so, less than 3 months before we sort of end the month of March.
Thanks for starting us off on a great mood, Prashant, telling us how bad our portfolios are.
I mean, it's not, but I'll tell you what, you look at some of these stocks, right, from pre-COVID levels, if you want to really go back all the way there, I mean, stocks are still up 2x, 3x. I mean, there are very few stocks, and that may be a good exercise to do, which are back at those levels. I mean, I highlighted Sobha earlier, which is back at, but far and few in between across large sectors. Stocks are still up quite a bit from pre-COVID levels. Forget about that COVID dip, of course. That was short-lived. It was brutal, short-lived, but it was also unnatural. Well, before we go any further, let me quickly tell you what is lined up in the first half hour of the show today. We will get you updates from markets across the globe. Steve Bryce of Standard Chartered Wealth Management will be joining in to discuss the global setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At about 8:30 this morning, we do a fundamental stock analysis with Devin Choksi of KR Choksi.
Okay, so lots coming up in the next 2.5 hours, but without wasting any time, let's get talking about what to expect on the equities front first up. Well, we have a view that's coming in from Morgan Stanley, where Rhythm Desai says peaking short rates, improving terms of trade and earnings strength appears to offer a better setup for stocks. Rhythm adds that risks such as a global growth slowdown, energy prices and global liquidity, amongst others, bear watching. India's implied volatility is likely to remain relatively low.
All right, this is Mahesh Nandurkar of Jefferies, who says that the recent correction in market has made valuations more palpable at 17.2 times one-year forward earnings. 56 of the Nifty 100 stocks now trade below the 10-year historical average. Several financials, select autos and pharma, trade at a discount to averages. Mahesh adds recent improvement in current account deficit, weak commodities driving WPI softening, and recent weakening in crude augur well for the macros. They've added Ultratech Cement and Sun Pharma to the model portfolio and reduced weight on metals and Tech Mahindra.
All right, let's also get you some money market views this morning and tell you how to approach the currency today. On the rupee, Kunal Sodhani of Shinhan Bank says the dollar index remained weak and fell for the second day in a row, even as US yields rebounded. The immediate test can be the weekly low of 101.9, and a level above 103.5 will be positive for dollar bulls. Euro holds firm, helped by expectations of further rate hikes from the ECB. For the dollar INR, Kunal says 81.80 to 81.90 zone acts as a support, while 82.35 acts as an important resistance.
Well, on bonds, we have Neeraj Gambhir of Axis Bank, who says the 10-year benchmark bond yield traded in a very narrow range of between 7.29 to 7.33%. Shorter tenor bonds and T-bills witnessed selling on account of finance bill amendments, which caused debt mutual funds to lose a favorable LTCG taxation benefit. For the rest of the week, market will take cues from the government's borrowing calendar, and he expects the 10-year benchmark to trade in a range of between 7.28 to 7.35%.
Well, we have a lot of stock-specific action we're going to be tracking for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at the Adani Group, Vedanta, ICICI Lombard, ZF Stirling, RHI Magnesita, JSL Stainless, SML Isuzu, NBCC, PNB Housing. They are stocks on the back of positive news flow. While on the flip side, you have CE Infosystems. That's the only stock that could be reacting to negative news flow.
All right, Steve Bryce is now joining us, Chief Investment Officer at Standard Chartered Wealth Management. Steve, good to have you with us here. Thank you very much for your time.